You think the market survived the weekend's Middle East chaos because the S&P 500 closed flat today. But a flat close can hide a bigger problem. Profit margins may be getting squeezed under the surface. The S&P 500 finished up just 0.04%. Tech and defense stocks helped support the index after a volatile session. In other words, a few strong groups can keep the index flat even while cost pressure spreads underneath. The real issue now is not just war headlines. It is the collision of three things: energy disruption, rising input costs, and higher borrowing costs. That mix can hurt corporate free cash flow, especially for companies that cannot raise prices quickly. Iran's Revolutionary Guards said the Strait of Hormuz is closed and warned ships trying to pass. But there is an important nuance. Reuters also reported that traffic had not fully stopped earlier, even as conditions were getting worse fast. So this may be less about a formal legal blockade and more about an effective choke point. That still matters a lot. Marine insurers are canceling war risk cover in key waters, and Reuters reported Middle East-China oil shipping rates are at a more than 6-year high. Even companies far from the region can feel this later through fuel, shipping, and packaging costs. The energy shock is real. Reuters reported Dutch front-month TTF gas rose about 46%, and oil jumped sharply intraday as shipping through Hormuz slowed dramatically. Reuters also reported Qatar halted production after Iranian attacks, and Qatar's LNG is a major part of global supply. At the same time, U.S. inflation pressure inside manufacturing is rising again. The ISM Manufacturing Prices Paid Index jumped to 70.5, the highest since June 2022. Reuters also noted ISM cited tariffs and higher steel and aluminum prices as key reasons. This matters because markets reduced hopes for a near-term Fed rate cut and Treasury yields moved up. That creates a squeeze: higher costs on one side and higher financing costs on the other. If you own smaller companies with high debt, this can pressure profits and cash flow faster than the index suggests. This is a risk scenario, not a confirmed result for every company. Some firms can hedge costs or pass prices through. Others cannot. Retailers and consumer brands are especially tricky here. If shipping and input costs rise but consumers resist higher prices, margins get squeezed. If companies discount to keep sales up, margins can get squeezed again. Investors did move into tech and defense today, and Reuters said those sectors helped keep the broader market steady. But safer does not mean safe. One important correction: the Amazon Web Services disruption in the Middle East was not confirmed by Reuters as a cyber attack. Reuters reported power and connectivity issues after unidentified objects struck a UAE data center, causing sparks, fire, and power cuts. So the better point is, this even digital infrastructure can be hit by physical disruptions. If instability continues, companies may have to spend more on backup systems, protection, and resilience. On consumers, Berkshire Hathaway reported Q4 operating profit fell 30% to $10.2 billion. Reuters cited lower insurance income as a major reason. It is a real warning sign, but not proof that the whole consumer economy is collapsing. Some analysts still argue the conflict is priced in. Reuters reported JP Morgan expected a short-term drop in risk assets and then a possible buy-the-dip opportunity. So the real debate is simple: is this a short shock or the start of a higher-cost environment? Trump was reported by Reuters as saying the conflict could last around 4 weeks, and other Reuters coverage said he would continue as long as needed. If disruptions last, margins matter more than index headlines. Tomorrow, watch 3 things: Fed comments, Target and Best Buy, and after-close earnings from GitLab and CrowdStrike. Keep it simple: watch costs, rates, and margins, not just the index. This isn't financial advice. Keep your eyes on the margins. I'm Wilson, and I'll see you tomorrow.